Hey everyone, and welcome back to the channel. If you've been investing for a while, you've probably focused heavily on domestic markets like the S&P 500 or the Nasdaq, and that's great. But are you limiting your potential? Today, we're going global. We're going to break down how major world stock markets are interconnected and why thinking globally is no longer an option but a necessity for the modern investor. Let's get started. So, when we talk about global markets, what are we really looking at? Beyond the familiar US indices, you have major players like the FTSE 100 in the UK, which represents the 100 largest companies on the London Stock Exchange. Think of companies like Shell, AstraZeneca, and HSBC. Then heading east, you have Germany's DAX, home to industrial giants like Siemens and Volkswagen. And, of course, there's Japan's Nikkei 225, a benchmark for the Asian markets for decades, featuring names like Toyota and Sony. In recent years, China's Shanghai Composite and Hong Kong's Hang Seng Index have become incredibly influential, reflecting the sheer scale of the Chinese economy with giants like Alibaba and Tencent. Each of these indices tells a unique story about its respective economy, its strengths, its industries, and its culture. Now, here's where it gets really interesting. These markets don't operate in a vacuum. They are deeply interconnected, like a complex web. A major policy announcement from the US Federal Reserve doesn't just move Wall Street. Its ripples are felt almost instantly in Tokyo and London when their markets open. Why? Because global capital flows freely. If US interest rates rise, investors might pull money out of emerging markets to seek safer, higher returns in US bonds. This can cause currency fluctuations and stock market dips in countries thousands of miles away. Let's take a concrete example: the US-China trade relationship. When trade tensions rise and tariffs are announced, it's not just American importers and Chinese exporters who feel the pain. A US tech company like Apple, which relies on Chinese manufacturing, sees its stock price become volatile. At the same time, a German car manufacturer that sells a lot of cars in China might see its stock fall on the DAX because of fears of a Chinese economic slowdown. You can see how one event creates a domino effect across multiple continents and multiple industries. It's a chain reaction. Another critical link is the supply chain. A natural disaster in Taiwan, a major hub for semiconductor manufacturing, can disrupt the production of everything from smartphones to cars globally. This will immediately impact the stock prices of tech and auto companies on the Nasdaq, the DAX, and the The pandemic was the ultimate stress test for these global supply chains, showing just how dependent companies worldwide are on each other. So, with all this interconnectedness and risk, why should you even bother with international stocks? The answer is one of the most important words in investing: diversification. Think about it. If your entire portfolio is in US stocks and the US economy enters a recession, your entire portfolio takes a hit. But what if, at the same time, certain emerging markets in Southeast Asia are booming due to a rise in their consumer class? By having exposure to those markets, your international holdings can help offset the losses in your domestic portfolio. It's about not putting all your eggs in one basket. Different economies move in different cycles. While one region might be struggling, another could be thriving. Global diversification allows you to smooth out your returns and reduce your overall portfolio volatility over the long term. Investing internationally also gives you access to growth opportunities you simply can't find at home. Think about the massive growth in e-commerce and digital payments in regions like Latin America or Africa. By investing in local companies leading that charge, you're tapping into powerful, long-term secular trends that might be more mature in developed markets. You get access to different industries, different consumer bases, and different innovation hubs. For instance, some of the world's leading renewable energy companies are based in Europe. If that's a sector you believe in, looking abroad is essential. So how can you get started? For most people, the easiest way is through ETFs, or exchange-traded funds. There are broad market international ETFs like VXUS, which tracks the total international stock market outside the US. You can also get more specific with regional ETFs, like one that focuses on European stocks or another on emerging markets. There are even country-specific ETFs if you have a strong conviction about a particular economy, like India or Brazil. These funds give you instant diversification across hundreds or even thousands of international companies, without you having to pick individual stocks and deal with foreign exchanges. It's a simple, low-cost way to build a global portfolio. To wrap things up, the world of investing is much bigger than just Wall Street. The global stock markets are a dynamic, interconnected system where events in one corner of the world can have far-reaching consequences. Understanding these connections from trade flows to monetary policies is crucial. But more importantly, embracing this global perspective through international diversification isn't just about managing risk. It's about unlocking a world of new growth opportunities. It's about building a more resilient, robust portfolio for the long run. So start thinking globally. Your future self will thank you for it. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more content just like this. See you in the next video.